Good afternoon. I'm Steve Campbell of Cornerstone Wealth Advisor Group in Fishersville, Virginia, and I hope your day is going well. Listen, it's wintertime, so we can now start hoping and counting down the days till maybe April Fool's Day because the weather will be a lot better. Today, I want to talk about bonds. I think bonds have actually entered into the land of schizophrenia. Um, uh, all the rules of the last 50 years in bonds seem like they've been turned upside down, and what used to be the way it is now totally the opposite. And a lot of people own bonds. And normally, bonds have been always a good source of income in retirement. Normally, bonds pay more interest than CDs do. But the last 3 years have really put bond investors to the test. And let me just talk a little bit about what's going on in the bond market. And what's going on in the bond market is, I think we have to trace back several years ago. I have always been at least somewhat impressed with the Federal Reserve, with Jerome Powell. I'm losing a little confidence in him, but first off, his job is not easy because you have monetary policy every year, and then you have the Congress to deal with. And the Federal Reserve could be doing their job every day of the week, and the Congress can be borrowing money and spending money we don't have and make that Federal Reserve chairman's job much harder. But if we go back to 2021, there was a lot of talk that the Federal Reserve should have been raising interest rates. And the bottom line was the Federal Reserve was probably 6 to 9 months late in raising interest rates back in 21. So they found out in 2022, we woke up to 9% inflation. We had 25 years of 2% inflation, and all of a sudden we're at 9% inflation, and it feels like Jimmy Carter 1980. The inflation rate was 12%, and unemployment was 13%, and our economy was teetering. I think that what happened was because Jerome Powell was late in raising interest rates, then he felt like he had to play catch up, and he just did actually raised rates a lot more than probably he should have in 2022. The end of 2022, he said, you know what, I'm going to cut interest rates now in 2023. And he didn't. He got to 2023. He couldn't lower interest rates, and he continued to raise interest rates in 2023. But then in November, he said, we are officially done in raising interest rates, and you can count on 2024. We'll be probably cutting rates 3 to 6 times in 2024 and 3 to 6 more times in 2025. And a couple months later, he came back and said, you know, I don't think we're going to cut rates now 6 times. I think we're going to cut rates 3 times. And then several months later, he came back and said, I don't think we're going to cut rates, but maybe 1 time this year. And the market didn't like it. And now what is interesting is he did cut interest rates in 2024, 0.5% in October, 0.25% in November, and 0.25% in December. You would think cutting interest rates would have really given life and breath to the bond market. No. The fact that the Federal Reserve cut interest rates 1% didn't help. Interest rates on the 10-year Treasury actually rose 1%, which rarely, if it's ever happened, it rarely would happen. We got the opposite effect. We got no good benefit of the Fed lowering interest rates. Bond yields have risen. Bonds have now lost about 3% in the last 3 months. And now we're left with, coming into 2025, there is still a belief that the Federal Reserve may cut interest rates, but I think he's thinking 1 time maybe. And the markets don't like uncertainty. So what should investors do? I guess that's what you're thinking probably. So the aggregate bond index, think of the S&P 500 for stocks, the top 500 companies. There is an index for bonds called the Barclays Aggregate Bond Index. And that is essentially thousands of bonds, about a third in U.S. corporate bonds, investment grade, a third in mortgage-backed securities, Fannie Mae, Freddie Mac, those types of bonds, and then a third in U.S. Treasuries. And with those thousands of bonds in the aggregate bond index, you would have a maturity of about 6 years on average for those bonds. I think that's not a great place to be this year. I could be wrong. Again, it's my opinion. But what we're doing for our clients are we're moving our clients down in duration to 2 years and maybe some bonds that have a 3 years. We even I believe that floating rate bonds that have a maturity of 60 days is not a bad place to have some of your money. So if you've ever heard of bond laddering, think about if you had $100,000 in bonds, I might want $20,000 in floating rate, $20,000 in a 2-year investment grade, $20,000 in a 2-year high yield bond, and maybe a total return bond that has a little bit of everything, that has a maturity of 3 years, and maybe have one that's out 4 years to kind of cover ourselves. We never can predict the future. Our job as financial advisors is to give the best advice we can give people. But I will tell you, the bond market could surprise us this year. And frankly, the only way we're going to see the Federal Reserve cut interest rates is if the economy slows down, which we don't want that to happen. So it's been a challenging time. Hopefully, if you can lower your maturities on your bond funds, you will end up with a better return than if you own the aggregate bond index, which last year, by the way, returned 1.3%. Not exactly a good return. So listen, you have a great day. If you have any questions that you'd like to direct to us, you can call us at Cornerstone Wealth Advisor Group at 540-942-1703. You can look us up on the internet, cswadvisors.org. And we do a radio show on Saturdays on WSVA in Harrisonburg at 7 to 8 a.m. I believe that is 550 on your AM dial and 92.1 on your FM dial. And we'd love to talk to you. Have a great day.
Content in this material is for general information only and not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly. All investing involves risk, including loss of principal. No strategy assures success or protects against loss. The opinions expressed in this material do not necessarily reflect the views of LPL Financial.